The weighted average cost of capital, also known as the cost of capital, is most of the time encountered in investment related topics. In screening decisions, most of the time the cost of capital is used as the hurdle rate. Now, in capital budgeting techniques, okay, the cost of capital is most of the time used, in coming up with the discount rate, or it's used as the discount rate to come up with the present value of our cash flows. So in this video, I'm going to discuss the basic components of cost of capital and why we need to compute for the weighted average cost of capital. Starting with the basic concept, the cost of capital actually represents the firm's cost of financing, and it is the minimum rate of return that a project must earn to increase the firm's value. Now, when we say cost of financing, this is how much you are paying every time you use other people's money. Okay, so you have the cost of debt, okay, and then you have your cost of equity. Those are the major sources of your cost of capital. And it says that the financial managers are ethically bound to only invest in projects that they expect to exceed the cost of capital. That's why your cost of capital is also known as the hurdle rate. Okay, it's used to evaluate projects. Ayan, and kaya nga na sinabi ko kanina, for screening decisions, the projects should have a return higher than the cost of capital. Ayun. And your cost of capital reflects the entirety of the firm's financing activities. So when we say entirety of the firm's financing activities, okay, this is the average. Okay, so we don't actually manage, or we don't actually use the individual cost of financing separately. We use them as a whole. So kailangan makompute natin yung average cost of capital. Now, most firms maintain an optimal mix of debt and equity financing. Now, when we say optimal mix of debt, we're basically talking about the best mix or the best proportion, between debt and equity. Okay, why is there a need to identify the best mix, or how do you describe the best mix, okay, for your debt and equity? This is actually the mix which will give us the lowest cost of capital, or weighted average cost of capital. In other discussions, like solvency analysis and debt ratio analysis, okay, we discussed that the point wherein your cost of capital is at its lowest, that is actually where the value of the firm is at its highest. And when it comes to financial management, we all know that the basic objective is to maximize your shareholders' wealth. Okay, and in order to do that, then we should operate within the optimum capital mix, or mix of debt and equity. Now, to capture all of the relevant financing costs, assuming some desired mix of financing, we need to look at the overall cost of capital rather than just the cost of any single source of financing. Okay, let's have an example. Let's assume we have this firm, okay, which is currently faced with an investment opportunity, and you have the following data. Okay, the best project as of today has a cost of $100,000 and the life is 20 years. Now, for this project, there will be an expected rate of return of 7%. Now, as of this point, okay, the least costly available source of financing, okay, is your debt. And let's say the rate, is 6%. So this is now the cost of debt. Okay, to simplify that further, every time you use 100 pesos, okay, you're going to pay interest amounting to 6 pesos. Okay, so something like that. Now, if we are going to use this cost of debt as our hurdle rate, whether we are going to accept the project or reject the project, okay, it appears that, this project is favorable. Why? Because it will be earning more, 7%. It will be earning more than the cost of debt, which is 6%. Okay, so utang ka, kunyari, bayad ka ng 6%, and then you invest that money, it will earn you 7%. So meron kang earnings, kumbaga na 1%. Now, let's continue. After 1 week, there is a new investment opportunity. And as of this point, the cost is, well, also 100,000. The life is also 20 years, but this time the expected rate of return is 12%. Now, as of this point, okay, the best cost of financing, okay, siguro it's the cheapest source of financing as of this point after 1 week is the equity or equity financing. And in this case, we have 14%. Again, if we use this to screen this decision, no, are you going to borrow? No, not borrow. Are you going to invest ka na lang? Are you going to invest your money in 12%? Okay, in this project, no, earning a return of 12%, and then, okay, you're going to pay the investors 14%, okay, for their money. Ayan, nai-invest nila sa'yo. Ganun lang naman yun eh. Okay, you have the investors, okay, putting their money in the company, and then the company is going to invest that for 12%, okay, and then you're going to pay, or the company is going to pay the investors 14%. So, are you going to accept that? Let's review, no, going to the past and going to our past slide. Okay, 7% versus 6%, accept. Okay, now this one, 12% versus 14%, lugi ka, no? Yung investor bibigyan mo ng 14% and then the return from your investment is only 12%. So this one will be rejected. Okay, now individually, it appears that we were able to come up with a sound decision. But if you try to look at it as a whole, no, what happened? You actually rejected a project with a return of 14%. And going back, you accepted a project with a return of 6%. So as a whole, parang lugi ka, no? Okay, because you use this separately, the cost of debt and cost of equity. Okay, because you use that separately, ang tinanggap mo yung 6%, ang nireject mo ay yung 14%. Okay, so now what if you computed for the average cost of capital? Okay, so the average cost of capital is actually the weight for your source of financing times your cost of financing. So let's just assume that the weight, no, for cost of debt and cost of equity is both 50%. I'm going to discuss the source of this 50% later. But as of this point, no, I just want you to understand that, let's say, out of your total financing, yung pinanggagalingan ng capital natin. Now again, this is financial management. When we say capital, we're not just talking of stockholders' equity. We are talking, or we are referring to the main sources of your capital, which includes long-term debt, no? So ayun, let's assume that out of your total capital, 50% comes from your equity, and 50%, okay, comes from your debt. So ayun, kaya ka meron kang 50% and 50%. So if your total capitalization is, let's say, 1 million pesos, 500,000 comes from the debt and 500,000 comes from equity. Anyway, so this is now your weights. Now, assuming these are the only sources of financing, we multiply that with the individual costs, no? For your cost of debt earlier, the cost of debt is 6%. Ay, wait lang. Mali. Eto pala no, napagbaliktad ko. Okay, I just want to correct myself. This one is 12% and we rejected that, no? And then earlier, okay, the return is 7% and this one, we accepted that. Ayun, so we accepted 7% and we rejected 12% because the return is lower than 14. Anyway, let's continue. Okay, your cost of debt is now, akyat na tayo, ayan, 6%. Okay, so you have here 6%. And your cost of equity is 14%. Ayan, so 50% times 6%, this is 3%, and this one will be 7%. Get the total. Ayan, so may summation siya doon, no? So get the total, and the total is 10%. This is now your weighted average cost of capital. And this should be the rate that you're going to use every time you make an investment decision. So, going back in our previous slide, instead of using 6%, okay, what will happen if you use 10%? Are you still going to accept this 7%? The answer is no, because it's now lower than your weighted average cost of capital. What about this? What if you use 10% instead of this 14%? Okay, you're going to accept this because 12% is higher than 10%. Okay, now if you try to look at your investment decisions, you ended up accepting a project with a return of 12% and rejecting the project with a return of 7%. This is the main reason why you should compute for your weighted average cost of capital and use that in decision making. Okay, now let's continue. Okay, so what if instead the firm used a combined cost of financing? Ayun, na-compute na natin kanina. No, if you try to summarize, okay, in the first project, you have your return, okay, rate of return of 7%, and then you have the cost at 6%. Okay, in the second project, the rate of return is ayun, 12%. 12% and the cost of financing as of this point is 14%. If we use them individually, you are going to accept this and you're going to reject this. Okay, if you use this 6 and 14%. But if you use 10%, okay, this one will be rejected and this 12% will be accepted. Okay po? So, ayun. Now, still on the basic concepts, okay, if we are talking about the capital or major sources of long-term capital, normally, ito lang siya. It's composed of your long-term debt and the stockholders' equity. Now, in accounting, pag purely accounting, every time we use the term capital, it's the difference of assets and liabilities. And that is now your stockholders' equity. But for financial management, every time we use the term capital, we are referring to your long-term sources of capital or major sources of financing. And that includes now your long-term debt. So, if you try to look at this, okay, what are now the major sources for our long-term capital? You have your long-term debt, you have your preferred stock, you have your common stock, okay, which is further classified into your newly issued common stock, okay, ayan, pwede yan. And then you have your retained earnings. Dito lang po manggagaling yung mga cost of capital, yung components niya. Ayan, so let's continue. Starting with the cost of long-term debt. Dalawa yan, you have your pre-tax and then you have your after-tax, okay? We only use the after-tax, but the after-tax cost of debt is computed after you are able to compute your pre-tax. Mas madali compute pag may pre-tax ka na. So, let's start. Let's start with your pre-tax long-term cost of debt or cost of long-term debt. Okay, so this is the financing cost associated with new funds through long-term borrowing. Normally in the form of bonds. Ganun. Ayan. Typically, the funds are raised through the sale of corporate bonds. Excited kasi nandun pala, sana binasa ko na lang. Now, what are net proceeds? These are the funds actually received, from the sale of the security. Okay, so when we say actually receive, eto na yung mapapakinabangan mo. For example, a bond with a face value of let's say 1,000 was sold for 900, but then you have to pay other costs, like your flotation cost, may admin cost yan, and so on and so forth. So you have to reduce that 900 pesos for every 1,000. So that's your net proceeds. Okay, so what are flotation costs? These are necessary costs in issuing and selling a security. Most of the time, you have the underwriting and administrative costs. Okay, so here's an example. Dutchess Corporation, a major hardware manufacturer, is contemplating selling 10 million worth of 10-year 9% coupon bonds with a par value of 1,000. Now, because current market interest rates are greater than 9%, the firm must sell the bonds at 980. So this one was sold at a discount. Flotation costs are 2%. Okay, 2% of this. So that's now 20. Now, if you're asked how much is the net proceeds, the net proceeds is 960. Why? This 1,000 was sold for 980 but you still have to incur 20. So, ang mapapakinabangan mo na lang talaga. The net benefit is 960. Okay. So, still in the long-term debt, no? Cost of long-term debt. The before-tax cost of debt is simply the rate of return the firm must pay on new borrowing. Okay? You have to take note of this concept because every time we compute for cost, ganyan lang yung pattern niya. You have the cost on top of the formula and then you have the net benefit at the bottom. Now, the before tax cost can be calculated in any of the three ways. Okay, you can use the market quotations, no? Observe the yield to maturity on the firm's existing bonds or bonds of similar risk issued by other companies. Okay, so that's one. Now, if you don't have that, you can compute, no, for the cost. You find the before tax cost of debt by calculating the YTM generated by the bond cash flows, or you can also approximate the cost. Okay, now based on the given example, okay, wherein you have the following rates. So, yan. So, you have 90. Okay. Ito yung mga interest na kailangan bayaran. This is now your net benefit. This is the phase, no? You can compute that by using your financial calculator or you can use Excel. Okay? So, ito yung formula natin sa Excel. Or you can approximate that, okay, by using the following formula. Ito na yung sinasabi ko. Ito yung mga common na pattern eh. Normally, you have here your cost and you have here the benefit or net benefit. Okay, now for the cost of long-term debt, if you try to analyze this, no, I stands for the annual interest, okay? And then you have the face value, okay, which is 1,000 minus ND. What is ND? This is the net proceeds from the sale. And then divide that, no? Divide that by N, which is actually the years. Now, the number of years to the bond's maturity. So, bakit ito naging cost? Take note, interest, you're paying for that. You're actually paying for that. But this one, you don't pay for this, but it will increase your interest expense because this is actually the amortization of discount. Amortization, diba? The difference of the face value and the net proceeds. Okay, that's now your discount. Divide that or you distribute that to the remaining life of the bond. So that's now your cost. And what about the net benefit? Okay, sir, bakit may plus siya doon? This is actually the formula for your simple average, no? You have the net benefit, okay, which is your net proceeds plus, okay, the face value. Bakit ganun? This is like the beginning balance, no? At the beginning of the duration of the bond. And at the end or at maturity, okay, this is now the value 1,000. So that's the ending balance. Beginning plus ending divided by 2, you will get the simple average for this type of bond. Okay, and that is now the benefit. Okay, so by applying that, okay, how much is our interest? You have, wait lang. Baka compute ako ng compute, nandito na rin lang pala. Okay, so wala pa. Okay, so you have here your interest. Going back to our previous slide, the interest is 90. How did we arrive at 90? That is 90% times 99 pala. 9% times 1,000. Okay, so balik tayo dito. Okay, so you have 90 plus, okay, you have 1,000 minus the net proceeds. How much is our net proceeds? Okay, kung naaalala nyo, it's 960. Okay, so balik tayo dito. 1,000 minus 960, diba? Parang yan na yung pinaka-discount natin, no? Divided by N, and in this case, it's 20 years. Okay, so you have 20 years as the life. Tama ba? O, 20 years. Okay, so we divide this by 20 years. Okay, so ayun, chill-chill lang, sundan mo lang. Okay, what about this? You have the net proceeds, which is 960, plus you have 1,000 divided by 2. Okay? So, kukunin ko lang yung calculator ko. Kunyari, nag-enjoy tayo dito. So, you have 1,000 minus 960. That will now be 40. Okay, we divide that by 20 and you will get 2. Plus 90, you will now have 92. Okay. Now, let's compute this. 960 plus 1,000. Okay, equals, divide that by 2 and you will get 980. Okay, so you now have 92. Divide this by 980 equals 0.09 or simply 9.38775% or 9.38% or 9.4. Okay, so now to continue, after getting the pre-tax cost of debt, you can now compute for the after tax. Okay, so how do you do that? You simply multiply your pre-tax cost of debt. In this case, it's 9.39, 9.39%, diba? Times, ayan, times, if your tax rate is 40%. Okay, so you multiply that by 1 minus 40%. And in this case, that will be 60%. So, hindi na ako nag-round off, no? Naka-memory in na lang, times 0.6. Okay, and you will get 5.63%. Okay, now in our textbook, okay, the same example, no? Ang ginawa niya, nag-round off siya ng maaga. So dito it's 9.4. Multiply that by 0.6. And you have 5.64. Okay lang naman. Okay, so this is now your cost of debt. Okay, the first component of our cost of capital. Ayun, ito pala, oh. Okay, so you have 9.4 times 40% pag hindi ka nag-round off, no? And you will get 5.6%. Parang iba yung lumabas sa akin, iba yung lumabas sa kanya. Okay, so sige nga, i-try nyo nga in our discussion, no? In our discussion board. Okay? Tama ba yung ginawa ko? Baka nagkamali ako. Ayan, can you compute, no? Can you compute for the after-tax cost of debt, no? Of this example, okay? Let's see kung pareho tayo na makukuha yung 5.6 or kung saan nanggaling ito. Ano kayang ginawa? Bakit 9.452 sa kanya? Okay po. Now let's continue. Anyway, before I forget, this material came from the materials provided by Gitman. Okay, and the whole version, no, yung full version, ayan, whole version. The full version is already loaded in your modules. Okay, so dahil ang haba-haba nung full version, pinili ko na lang yung mga parts na kailangan ng discussion. Anyway, to continue, okay, you have your cost of preferred stock naman. Okay, after bonds, okay, or long-term source of debt, dun tayo sa preferred stock. This is an example of a hybrid security, no? Bakit siya hybrid? Although it is called stock, okay, which represents ownership, yung dividends na binibigay natin sa kanila is fixed. So it's more like interest. Ganun pag tinitingnan mo yung substance. Anyway, let's continue. How do you compute for the cost of preferred stock? Very easy. The formula is the dividends given to this stock, and then you have the net proceeds from the sale of your preferred stock. Okay, now if you don't have the net proceeds, you can also use the fair market value of your preferred stock. Now again, if you try to look at this formula, yun na naman yung concept niya. What's the cost of using preferred stock? Okay, the cost is the dividends, no, that you pay, no, to your owners. And then what's the benefit? Okay, benefit will now be the net proceeds from selling your preferred stocks. Okay, so here's an example. It's already computed for you. Ayan, so if you have this 10% preferred stock and it's expected to sell at 87 per share, the cost of issuing and selling the stock will be 5. Okay, so what is now the dividend? That will be 10% times 87. Aba, minultiply siya sa ano, no? Sa expected selling price. Siguro, the expected selling price is the same as the par value. Okay. So, ayun. And then, ano pa? You have 87 minus 5. Okay, why? Because you have flotation cost yan. Cost of issuing and selling the stock, which is 5 pesos. So, now you have 82. And in this example, you have 10.6%. Okay, so another question, paano kapag magkaiba yung par value and the expected selling price? Okay, where are you going to multiply that 10%? Will it be the par value or will it be the expected selling price? Okay, now let's continue. So, ganun lang yung cost of preferred shares or preferred stock. Now, you might be asking, sir, why don't we multiply that with the after-tax rate? No, take note, the interest paid to bonds kay is tax deductible. So, may effect siya sa tax. Because the more debt that you incur, okay, the higher will be the interest expense. Higher interest expense will mean lower income tax, which will result to lower tama pala. Higher interest will mean lower net income and lower net income will mean lower income tax. But in the computation of your net income, we don't deduct the dividends, no? That's why the cost of preferred shares and cost of common shares will not be multiplied, no, in the net of tax, no? Will not be multiplied by 1 minus your tax rate kasi wala naman siyang effect sa tax. Now, let's continue with your cost of common stock. Dalawa po ito, okay? It comes in the form of retained earnings and new issues of common stock. Now, if the project or the investment will be financed, no, by existing common stock, ayan, we just use the cost of retained earnings. But if we are going to issue new stocks, okay, we use the cost of newly issued stocks. Ayan, okay, for this point, no, as of this point, we are just going to discuss first the cost of common stock, which is the cost of your retained earnings. Okay. Now, how do we compute that? There are different tools. Most of the time, we use the Gordon's model, also known as the constant growth valuation model. And we have the capital asset pricing model. Okay. So, paano yung constant growth valuation model? And this model assumes, no, that the value of share of stock equals the present value of all future dividends. So, yung mga dividends na matatanggap mo sa hinaharap, okay, you're going to discount that, which means you get the present value of all those dividends. Okay, you get the total, and that should be the fair market value of your stock. Okay, so from there, no, PO, this is the market value, okay, which is computed by dividing the dividends, okay, which is assumed to grow at a constant rate. Yan. So we divide that by the difference of the required rate of return on common stock, okay, less the constant rate of growth in dividends. Now, pagbabalik-balik ta rin mo yan, hahanapin mo lang ito, itong part na to, okay, and that will now be, diba? Parang mag-work back ka lang. Pag nahanap mo to, that is now your cost of common stock using the constant growth valuation model. Okay, so ayun na nga. Okay, so this is now the formula that we are going to use. Okay, let's have an example. Now, the same company wishes to determine its cost of common stock equity. Okay, the market price, okay, is 50 per share. And the firm expects to pay a dividend D1. Ayan, at Ayan, of 4 pala. Ayan, $4 at the end of the coming year, which is 2013. The dividends paid on the outstanding stock over the past 6 years were as follows. Naku, hindi niya binigay yung growth rate. Now, let's see, baka nandito. Ayan, we can calculate the annual rate at which dividends have grown, okay, from 2007 to 2012. And it turns out to be approximately 5%. Paano na-compute? Hindi pinakita. Pero just to give you an idea, if you have Excel, no, if you have Excel, the first step is to get the difference for this one. Okay, and then yung difference niyan, difference niyan, difference niyan, difference niyan. Once you have the difference, okay, you divide that, no, by the value at the beginning, okay, and then you get the total, and then you divide that by how many years. In this case, you divide that by 5 years, kasi ito yung base year. If this is your base year, okay, the growth rate for this one will be 0. Okay, so let me just get my calculator. Let's see. Now, let's check if we will be able to arrive at 5% or 0.05. So, let's see. You have 2.97 to 3.12. Ay, dito muna tayo sa taas pala. 3.8 na yan. 3.8 divided by 3.62. This one will be 0.18. Okay, so you have 0.18 and then 3.62 minus 3.47 equals 0.15. This is not the growth rate yet, no? Okay? Papakita ko lang sa inyo kung paano po na-compute. Tapos, you have 3.47 minus 3.33. You will get 0.14. Okay, and then 3.33 minus 3.12. 0.21. And then 3.12 minus 2.97. 2.97. So you have 0.15. Ayun, 0.15. Now, we divide these by our base year. So, dito, ang base year ng dalawang to is 2.97. And then, eto, you divide that by 3.12. This one, you divide that by 3.33. Divide this by 3.47. Then, you divide this by 3.62. Okay. Kunyari, dinivide nyo na yan. Okay. You get the total and then you divide that by 5. Okay. So, tama ba? I-check na natin. Nakakatakot. 0.18 divide this by 3.62 equals, yun, mas maganda pag hindi tayo magra-round off, pero this one will be 4.9723 and 23. Then 0.15 we divide this by 3.47. Dapat di ko na ginagawa pala ito, no? Napalayo na tayo eh. Pero napasubo na ako, kaya sige na nga. 3227 or 3228 na dapat yan. Sige, round off natin. And then you have 0.14. 0.14. Divide this by 3.33. You have 4.20. 4.24. 0.21 divided by 3.12. Tapos iba pala yung lalabas. Pahiya na naman ako. 6.7307 or 08. Tapos 0.15 divided by 2.97 and you will get 5.0505. Okay, and get the summation. Yan. Okay. Oh. Sige, i-total mo. 4.9723. Nag-utos pa ako, no? Ako rin lang pala ang gagawa. 3228 plus 4.2042 plus 6.7308 plus 5.0505 equals, and then we divide this by 5. Okay. Ang nakuha ko po ay 25.2806. Yan. I-share nyo nga, pareho ba tayo nang nakuha? We divide this by 5 years. Divide that by 5 and you will get, I got 5.05612. Okay, so this is now your growth rate. Okay, now to continue, okay, so ayun, dito ang ginamit niya is 5.05. And then by substitution, so you have 4 for your dividends, you divide that by 50. Okay, and then kung ano man yung nakuha mo, you add 0.05 or 0.0505. And in this example, you now have 13%. So that's now the cost of your common stock using the constant growth model. Okay, now if you're going to use the capital asset pricing model, this is already discussed in other topics, no? But as a review, this is the equation of your CAPM. You have the risk-free rate, okay? You have here your beta, okay? You have the market's return, okay? And then you have the risk-free rate. The difference of these two is also known as the market premium. Beta is now a measure or an indicator of its volatility or the risk, no? This is actually how much the assets rate of return will increase, no, in relation to the changes in markets rate of return. So kung tataas yung market natin by 1% and your beta is 2, we expect that the company will increase its return by 2%. Okay, so parang multiplier lang siya. The risk-free rate is actually the lowest rate of return available, okay, in investments, no? Kaya most of the time this is what we use is the rate coming from your treasury bills or treasury notes. Okay, so if you try to apply that, okay, given the following, you have, sige, so ulitin natin, where is your risk-free rate? Sabi niya, the risk-free rate is 7%. Okay. Now you add that to your beta, which is 1.5. But then you have to multiply that first with the difference in the market's rate of return, which is 11%. Okay, and then minus 7% for your risk-free rate. Okay. And you will now have 11 minus 7%, that's 4%. 4 times 1.5, that will now be 6. 6 plus 7, that will now be 13%. We now have 13% using the CAPM model. CAPM lang pala. Okay, so this technique differs from the constant growth valuation model because it directly considers the firm's risk as reflected by beta. Now, for constant growth model, it does not consider the risk. It uses the market price as a reflection of the expected risk-return preference of the investors in the marketplace. Okay, and then, okay, it doesn't mean that one is better than the other tool, no? Okay, magkaiba lang naman sila ng mga assumptions dito eh. The constant growth valuation and CAPM techniques for finding the cost of stock are theoretically equivalent. Okay, though in practice, estimates from the two methods do not always agree. Okay, so pag minsan mas mataas ng konti yung isa, ganun. Another difference is that when the constant growth valuation model is used to find the cost of common stock equity, it can easily be adjusted for flotation costs, okay, to find the cost of the new common stock. While for CAPM, you cannot make any adjustments for flotation costs. And the difficulty in adjusting the cost of common stock equity calculated using CAPM occurs because its common form in its common form, the model does not include the market price, okay, which is a variable needed in the adjustment. Okay, so now let's continue. You have the cost of debt, which is after tax. You now have the cost of preferred stock, and then you now have your cost of common stock, okay, using constant growth or capital asset pricing model. Now, for your cost of equity, it's very easy because this is equal to the cost of stock. Ayan, so sabi dito sa slide natin, this is the same as the cost of equivalent fully subscribed issue of additional common stock, which is equal to the common stock equity. So you have RR is equal to RS. The cost of retained earnings is equal to your common stock. So in this case, it's also 13%. Now, if we are going to compute for the cost of new issues naman, okay, magkaiba na. It's not your it's no longer the cost of retained earnings, okay? Anyway, let's continue. Sabi niya, it's the cost of common stock net of underpricing and associated flotation costs. So you have to make certain adjustments. Now, using this model, your constant growth valuation model, diba, D1 is your dividends, and that's now the net proceeds plus the growth rate. Okay, so, ayun. Na-discuss na pala. Okay, so we have the following example. Okay, so what is this 4? Okay, divided by 44.5 plus 0.05. Okay, sabi dito you have a flotation cost of 5.5. So you now have to adjust your asan na dito? Tama ba? The total underpricing pala and flotation cost per share is therefore 5.5. So this will now be your adjustment to get your net proceeds. Okay? Since it can be sold for 47, di ba dapat ibabawas mo muna yun, no? And then 3 per share underpricing is due to the competitive nature of the market. Okay, so para maibenta mo, parang ganun na lang para madaling intindihin. Para maibenta mo yung stocks mo, okay, magbaba ka na lang ng 3 pesos. A second cost associated with the new issue is flotation cost of 2.5. So yun pala, doon nang galing yung 5.5. 2.5 plus 3. Okay. And then you compute, you now have 14%. Tapos, yun, naalala ko na. Ang question pala dito dati ay, sir, di ba, 47 minus 5.5, hindi naman 44.5, okay? Instead, ang makukuha mo dito ay 41 yata. 41.5, okay? So, yes, tama. Pero take note, kaya tayo merong 47 because originally, okay, the value is 50. So, in-explain lang niya dito, why is it sold for 47? Ayan, sabi na 47 eh. Why is it sold for 47? Kasi na-underpriced siya by 3 due to the market's competitive nature. Okay, so, and then you have other flotation cost which is 2.5. Okay, bulahin natin dito. Okay, so minus 3 minus 2.5. Okay, so magkakaroon ngayon tayo dito ng 44.50. So, yun po yung net proceeds natin. Okay po? So, sir, paano po na-compute yung 4 but wala dyan? Again, this is also given. Balik na lang tayo para hindi kayo malito. Alam ko given yan eh. Ayun, yun yung dividends natin na 4. Okay, the value of the stock is 50 and the growth rate which is 5%. Actually, na-compute natin yung kanina 5.05 dapat. Pero sige, let's just use 5%. So, 50 minus 5.5, you'll get 44.5 and then you have the dividends of 4. Okay, so siya yun plus yung growth rate natin. And you will now have 14%. Okay? Ayun. Smile, we are almost done. Now you have the weighted average cost of capital. Okay, the weighted average cost of capital reflects the expected average future cost of capital over the long run. Okay, now this is under the assumption that there will be no significant changes in our weights. Okay, now this is found by, ayan, weighting. Tama, weighting. The cost of each specific type of capital by its proportion in the firm's capital structure. Okay, so you have there, no, the formula. Let's just apply that later. Now, three important points should be noted for the equation. For computational convenience, it's best to convert the weights into decimal form and then you leave the individual cost in percentage terms. Sa akin naman, it's vice versa. As long as yung isa naka percentage tapos yung isa yun yung naka decimal form, you get the same results. The weights must be non-negative. Siyempre, hindi pwede yun eh. No, like for example, if this is your total capital, okay, you cannot have a negative ratio. Okay, the lowest will be 0.0001%. You cannot have a negative weight. Okay, and all of them should add to 1. Okay, kunyari you have 25%, 25, 25, 25. Okay, the firm's common stock equity weight is multiplied by either the cost of retained earnings or the cost of new common stock. So it really depends whether the firm's common stock equity will be financed using retained earnings, okay, or gagamitin natin old stock. Yun yung term sa ibang textbook. Or new stock. Pag new stock, that's your newly issued shares. Okay, so let's now have an example. Now, to summarize, these are the cost of debt, yung na-compute natin kanina, cost of preferred stock, cost of retained earnings, and then you have your cost of new common stock. And then you have the following weights, okay, which is 40, 10, and 50. So this means that common stock equity. So this will be financed by issued stocks already. Okay po, so the total is 1. Yes, the total is 1. So we simply multiply, di ba? Ano yung gagamitin kaya natin? 14% or 13%? Kunyari may sumagot, correct yung sagot ninyo. We are going to use 13%. Okay, so you simply multiply that and your weighted average cost of capital now is 9.8%. Okay? So, ayun, no? Yan yung gagamitin natin sa mga accept-reject decisions natin or for capital budgeting techniques. If you need a rate to use, no, so that you will be able to discount the cash flows to their present values, ito yung pinakamagandang gamitin. The weighted average cost of capital. Any investments made above the weighted average cost of capital will guarantee that the value, tama ba? Will guarantee. Okay, assuming all variables are the same, ganun na lang, will result to a higher value for the firm. Okay, investing below the weighted average cost of capital will reduce, no, the value of the firm. Ayun. And then again, last of the questions that I normally get is that, sir, so paano nako-compute yung book weights? Okay, madali lang naman. How do you compute for your weights out of your total capital? You simply divide, no, how much of that came from your bonds or long-term liabilities, how much of that came from your preferred shares, how much of that came from your common shares, and ganun. Pero we have some variations kasi. Okay? You can use the book value or market value. You can also use the historical or the target. Pag sinabi nating book value, this is dependent, no, on the existing, no, on the existing accounting values. Ibig sabihin, it's based on the existing financial statements. Ganon. Pag sinabi nating market value, okay, this one is based on what is normal in the market or what is normal in the industry. Okay, so pag book, it's based on the firm's financial statements, okay, or yung firm's actual capital mix. Pag sinabi nating market, Okay? This is based on the industry. Pag historical naman, this is self-explanatory. Historical, anong nangyari sa past. Okay? Pag target, what is the target weight? Okay? It's future-oriented naman. So if you have book versus market and historical versus market, if you try to put that together, you can actually come up with 4 kinds of weights, no? You have the based on book value na historical, or you have historical book value, you have the target book value, or you have your, hindi pala plus yan, you have your historical, and you have your historical market value, or you have your target market value. And the best weight is always the target market value. Diba? Bakit mas maganda yung target? Because this is what is expected, what will happen in the future. Past is past nga daw eh, diba? Historical is already sunk. Okay, and what happened in the past is not a guarantee of what will happen in the future. Diba? So, kung sino ka, ayan, based sa iyong nakaraan, ayan, walang connectment daw yan kung sino ka daw ngayon. Okay, ang OA na. And then you have your book versus market value. Why is the market value better than the book value? Because the market value weight is based on the industry standards. Okay, na kung saan nag-ooperate yung company. Samantalang yung book value, it's just based on the company's own capital structure. Okay, so I guess that's it. Okay, thank you for listening.